All right, last but not least, we're going to cover the double declining balance method. You might also just see the declining balance method, but you often see DDB for double declining balance. And double declining balance is very similar to straight line times 2. It's not exactly correct, but it is the basic methodology. Is double declining is straight line times 2. Okay, so let's just go to our example for me to show you what I mean. All right. So here we are, here is the asset. We're using the same $24,000 asset with the same residual value of $2,000, and we're saying that it is going to be good for 5 years. Okay, so rather than go with the slides, I'm going to go with what we've got here. So let's get rid of what's here, and here we go. So our asset is worth $24,000, all right? So whatever this asset is I gotta draw my T accounts better. The asset is $24,000. And now let's look at how we're doing the double declining balance method. So this is what I suggest. The first step here, there's 2 steps. The first step is to figure out what the rate is that we're going to use for depreciation. Okay, there's 2 ways to do this. The way that I'm going to show you first is really for you to understand the methodology, and the second is almost going to be a shortcut, kind of a cheating method. Alright, so if we're going to say, I said before it was like straight line times 2. So if this asset is normally good for 5 years, then that would be 1/5 each year, right? 1/5, 1/5, 1/5, 1/5, 1/5, right? That's going to be 1/5 for 5 years, right? So every year of depreciation would be 1/5 for the first year, 2/5 for the second year, so on, right? So the idea here is it would be that 1/5 is straight line depreciation. Each year would be 1/5, which is equal to 20% basically. And it'd be straight line, which is 20% times 2. So the rate we're going to be using in this problem is actually 40% to do the calculations we're about to do. Alright, you could also look at it just as simply as to say straight line is 1/5. You can multiply by 2 right now if you want to, and 2/5 is equal to 40%. Okay, either way, the idea is it's straight line times 2. Alright, you're coming up with the same 40% rate. Now the way to cheat a little bit, I don't even want to tell you guys this, but the way to cheat on this a little bit is to think if it's 5 years, the depreciation, then just put a 2 on top of it. Put a 2 on top of whatever the number of years is. Alright, so put a 2 over, in this case, the number of years is 5. There you go. There's your 40%. Alright, this is not the problem, but let me just show you. So let's say an asset was going to be good for 10 years. Well, put a 2 over the number of years the asset's going to be good for. The depreciation is going to be 20%. That will be the rate. Alright, so you get the idea. You can put 2 over whatever the number is, number of years that the asset's going to be good for, and you'll come up with the rate. Alright, so now let's get into the actual calculation. This is really like step 1 is figuring out the rate, because you can't go any further if you haven't figured out the rate. Step 2 is to do the actual calculation. Now, this asset was $24,000 and it had a $2,000 residual value. Well, this is the only scenario where you start off with the full amount of the cost of the asset. You do not take into consideration the residual value at this point. So here we are. Let me actually start off this way. It's year 1, and your asset's value is $24,000, and you're going to multiply that times the 40% rate, and that is going to be, I have no idea, let's say 24,000 at 40% is $9,600. So in year 1 you're going to have $9,600 worth of depreciation. Okay, so just to keep us going here, I'll draw us a nice little T account, accumulated depreciation. And your journal entry is always the same, as we know, debit depreciation expense, credit accumulated depreciation. Alright, so here we go. And in our first year, as I said, we calculated $9,600. And it's a contra account to the asset, so it carries a credit balance. Alright, so here we go, moving along. So I would take, this is how I like to look at it. The $24,000 is the asset cost. Subtract from there the $9,600. Alright, let's get underline. Nope, can't underline in this. Okay. And here we have year 2. We have the book value of year 2 is $24,000 minus $9,600, which is $14,400. Oh, not too economous. 14,400. That is the book value right now of this asset, right? 24,000 minus 9,600, 14,400. Now you're going to take that amount, again, times 40%. And it's going to be $5,760. So in year 2, you've got $5,760 of depreciation. All right, you're going to subtract that amount, minus 5,760. And we're going to have year 3. Probably should have done this in Excel, but that's all right. We're doing okay here. So 14,400 minus 5,760 is 8,640 is the new book value, times 40%. We are going all the way through this for a reason here. Times 0.4 is $3,456 of depreciation in year 3. So now we're going to subtract $3,456, and we've got year 4. And 8640 minus 3456 is, let's see, year 4 is, the book value is $5,184. Oh, I forgot to fill in depreciation this year. Depreciation is $3,456. All right, year 4, so 8640 minus 3456 gives you $5,184. Let's try that again. Can't seem to draw my boxes here. Times 40% is equal to $2,074. I'm rounding. All right, final year here. All right, so what we've got, let's step back for a second, because in the final year we always have to do something a little bit special. All right, so here we go. 5,184 minus 22,074 is 3,110. Okay, that's where we are right now, and we're ready to do year 5. Year 5 is going to be a little bit special. Let's add in all the amounts we have so far for accumulated depreciation. 9,600 from year 1, 5,760 from year 2, 3,456 from year 3, and oh wow, I have these out of order. Hang on, sorry guys. This should be 2,074. All right. And there should be a minus sign there. Pretend there's a minus sign there. It's too hard to draw on here. All right, so here we go. And you've got 2,074. All right, so once you add all of these guys up here, what you're going to come out to so far, oops, actually I don't want to draw that yet. What we're going to come out with, if you add together the 9,600, the 5,760, the 3,456, and the 2,074, is you're going to come out with, what you've got here so far, is you've got 20,890. All right, so if you're adding these guys together, you're going to get to 20,890. All right, so that's where you are right now. Well, where do I want to be? What I want to end with is a $2,000 residual value, right? So 24,000 minus 20,890 puts you at more than $2,000. What I want this to be is I wanted my accumulated depreciation to be 22,000. So if I take my asset 24 minus $22,000 in accumulated depreciation, I'll have the $2,000 residual value. So ultimately, I want this number to be 22,000. Well, with this method, year 5, if I multiplied year 5's amount times 40%, it is not going to come out cleanly, right? It is going to come out way higher. Feel free to do the math yourself of 5,184 minus 2,074. What I've got so far is 3,110 is my book value. If I were to take that amount times 40%, it's going to put me higher than I need to be. It's going to be more depreciation than I'd like. So what I need to do is calculate 22,000, the amount I want it to be, minus 20,890, the final year, and I'm going to basically plug the value. 22,000 minus 20,890 is 1,110. In my final year, I'm going to force the value to be what I want it to be. And I cannot make that go. All right, I'll have to redraw my lines here. Now if I add all these numbers up, I'll be at 22,000. So in this last year, In this method, I force the final value to be what I want it to be. So in the last year of depreciation, I have just calculated that I want the number to be 1,110. Okay? So this way I have total accumulated depreciation of 22,000, total asset of 24,000. You look at them, and the net book value of the two is now 22,000. And that's it for double declining balance. See you in a minute.